You open any financial news app right now, and the retail market is obsessively chasing the exact same headlines, you know?
Oh, yeah. Everyone is tracking NVIDIA's every single move.
Right. They're analyzing GPU shipment delays, basically trying to ride the absolute most crowded trade in the market. But while retail is fixated on the obvious, the smart money is quietly accumulating a completely different asset.
Which brings us to our focus today.
Exactly. Welcome to this deep dive into Broadcom, ticker symbol AVGO. The question we're answering today is really simple. Is Broadcom the true hidden gem of the AI infrastructure boom?
It is the critical question.
Mm-hmm.
And to answer it, we are not going to deal in hype or casual tech commentary. We're operating strictly on fundamentals today.
Yeah, we have a massive stack of SEC filings on the desk, including that pivotal April 6, 2026 Form 8K.
Right, along with the Q1 2026 earnings transcripts, granular valuation models from GuruFocus and Simply Walsane, and the raw hardware specs coming out of the 2025 OCP Global Summit.
We are applying strict discipline to this analysis. No fluff, no storytelling that doesn't serve the thesis. We're looking at hard earnings numbers, pricing reality versus these deeply fractured valuation models and forward triggers.
Let's start with the foundation then. I mean, we can't understand Broadcom's market position without first dissecting the Q1 2026 earnings. We have to see what is actively driving their revenue.
Okay, let's get into it. What are the numbers telling us?
Well, the Q1 numbers present a very specific, undeniable narrative. Total revenue hit a record $19.3 billion.
Wow, so that's what, a 29% year-over-year increase?
Exactly, 29%, bringing net income to $7.35 billion. But the critical line item here, the one that totally changes the thesis, is their AI semiconductor revenue.
Right, the AI segment. What did that hit?
It hit $8.4 billion, which is up 16% year over year. So AI revenue now accounts for roughly 43% of Broadcom's total quarterly revenue. We're looking at a massive structural shift in their income statement.
Okay, wait, let's look under the hood here, because I'm going to challenge that bullishness right out of the gate.
Okay.
If you look closely at that exact same earnings report, non-AI semiconductor revenue was totally flat at $4.1 billion.
Yes, it was.
Furthermore, their infrastructure software segment barely eked out, like 1% growth. So my question to you is this. Are we just looking at a legacy business that's basically masking a core systemic slowdown with a temporary AI sugar high?
If you are only looking at top-line revenue aggregation, I could see why you would think that.
Right.
But if you strip away the legacy software numbers and isolate the hyperscaler data, it fundamentally invalidates the bear argument. This is not a sugar high.
Explain that. What are we actually seeing in that $8.4 billion figure?
What you're seeing is a massive permanent pivot by hyperscalers toward custom application-specific integrated circuits, or ASICs. I mean, Broadcom isn't just selling more generic chips. They're dominating a highly specialized, rapidly expanding subsector of AI compute.
I want to break down the mechanics of that pivot for the listener, because the distinction between a GPU and an ASIC is really the entire ball game here.
It absolutely is.
So NVIDIA essentially sells universal wrenches. A GPU like the H100 is an incredibly powerful, versatile tool. But because it's a universal wrench, it has to spend electrical power figuring out what task you're asking it to do before it even executes the math.
Exactly.
An ASIC, on the other hand, is basically a custom mold. I want to know exactly how that structural difference translates to the balance sheet.
It translates directly to operating margins. Because an ASIC is a custom mold, the physical pathways on the silicon are permanently etched for one specific algorithmic equation.
So the electricity has nowhere else to go.
Right. It doesn't have to compile instructions or decide how to route data. That is exactly how Broadcom slashes power consumption.
And the market consensus believes that off-the-shelf, general-purpose GPUs will dominate forever.
That's the huge blind spot. What they are missing is the industry's rapid pivot from the training phase of AI to the inference phase.
Because training an AI model is about brute force. It requires universal wrenches because the model is still literally learning how to think.
But running an AI day-to-day, which is inference, requires ruthless efficiency. Broadcom designs custom tensor processing units, or TPUs, specifically for Google.
And because of that etched silicon architecture you just mentioned, those TPUs use, 2 to 3 times less energy than an NVIDIA H100?
Exactly. They use vastly less energy and boast 30% to 40% lower inference costs.
See, when you're deploying tens of thousands of these chips in a hyperscale data center, 30% lower inference costs isn't just some rounding error on an earnings call.
Not at all. Deploying Broadcom's custom ASICs saves companies like Google hundreds of millions of dollars in electricity alone.
And that brings us directly to the April 6, 2026 SEC Form 8K, because this filing is really the undeniable proof of the shift from training to inference.
Yeah, Broadcom didn't just announce a minor partnership here. They locked in a 5-year TPU deal with Google.
Meaning they secured their position as the primary custom silicon provider through 2031.
Right. But if you want to look at sheer scale, the deal with Anthropic is even more staggering.
Okay, Anthropic, the company behind the Claude large language model. This is where the sheer physical scale of the infrastructure gets hard to comprehend.
It really does. Broadcom secured a computing power order to provide Anthropic with 3.5 gigawatts of TPU capacity by 2027.
3.5 gigawatts. Just to put that into perspective for you, that is roughly the power output of 3 average-sized nuclear reactors dedicated solely to running custom silicon.
It's massive. Financially, analysts estimate that Anthropic alone could contribute anywhere from $21 billion to $42 billion in revenue to Broadcom over the life of the deployment.
Wow.
Yeah, Broadcom now has 6 major clients secured for its custom AI XPUs. They aren't masking a slowdown at all. They are aggressively monopolizing the custom silicon inference market.
Okay, so they have this massive guaranteed pipeline locked in with Google and Anthropic, but my screeners are flashing red right now.
The valuation algorithms.
Right. If this pipeline is so obvious, we have to look at the pricing reality. AVGO is trading around $371.55. It's up 70% over the last year. The forward PE sits at roughly 32.86.
Which sets off a lot of alarms for traditional models.
Exactly. GuruFocus literally stamps Broadcom with a bright red, significantly overvalued label. It's the kind of warning that makes algorithmic trading bots immediately sell.
They cite a GF value of $268.61, right?
Yeah, which makes the stock 38.3% overvalued by their proprietary metric. And Simply Waltzing shows a current trailing PE of 61.15, which is well above the semiconductor industry average of roughly 39.
The traditional algorithmic valuation models are absolutely screaming that this stock is a bubble.
So I'm going to push you on this. With a forward PE near 33, a trailing PE over 61, and a stock price sitting roughly 38% above its fair value, according to GuruFocus, how can any serious analyst call this a hidden gem? Hasn't the market already squeezed every drop of alpha out of this trade?
Well, if you build a valuation model treating Broadcom like a traditional semiconductor company, then yes, the alpha appears completely squeezed.
But you're saying we shouldn't treat them that way.
Exactly. Analyzing the severe tension between the bull and bear models reveals exactly why those traditional metrics are failing here. Let's break down the mechanics of the bear case. They value Broadcom at roughly $258.71.
Right. And how do they arrive at that specific number?
They are heavily relying on traditional discounted cash flow, or DCF models.
And a standard DCF model for a hardware company typically assumes a rapid mean reversion because of the cyclical nature of the business, right?
Precisely. The bears assume Broadcom is subject to the standard boom and bust cycle of chip manufacturing,
where a company sells a massive wave of enterprise servers, revenue spikes, and then revenue plummets for 3 years until the next hardware refresh.
Yeah, so the DCF model applies a high discount rate to future cash flows because it assumes those cash flows are highly volatile.
But the bull case completely rejects that premise. I mean, we see D.A. Davidson just raise their price target to $375, and long-term bull models are targeting $472.01 per share.
Because they're looking at the actual contracts. They explicitly cite a compute-constrained environment and are looking at a 2027 deployment roadmap of almost 10 gigawatts of compute.
Which brings us to the edge, the contrarian insight that traditional valuation algorithms simply cannot price in. We have to fundamentally challenge the narrative of these historical valuation metrics.
We really do. Because what most investors, and certainly algorithmic screeners, are completely missing is that Broadcom is no longer a standard cyclical semiconductor company.
So if you're building a DCF model at your desk right now, you cannot treat this like a standard cyclical chip stock. You have to model this like you're buying a municipal water utility.
Exactly.
Let's unpack that, because it sounds totally crazy to compare a cutting-edge AI firm to a local power grid.
It does sound crazy until you look at the contractual structure of their revenue. Broadcom is sitting on a massive $110 billion backlog.
Right.
These are multi-year supply agreements that literally guarantee capacity utilization through 2028. They have fundamentally transformed into a monopolistic infrastructure utility.
And you cannot value a locked-in recurring revenue utility using cyclical chip maker multiples.
Because the risk profile is entirely different. When Google signs an ironclad contract through 2031, and Anthropic commits to 3.5 gigawatts of capacity by 2027, that revenue isn't subject to the typical cyclical whims of consumer electronics.
It's guaranteed structural infrastructure spending.
Right. In valuation terms, predictable cash flow equals a lower discount rate, which fundamentally justifies a higher multiple.
So if you apply a utility like premium to that $110 billion backlog, the forward PE of 32 doesn't look historically overvalued at all. It looks surprisingly reasonable for a monopoly with zero demand-side risk.
Exactly. The bears are using the wrong math for the wrong business model.
Okay, so if the valuation models are this deeply fractured, with algorithms seeing a 38% premium and fundamental bulls seeing a monopolistic utility trading at a discount, the tiebreaker for investors has to lie in the forward triggers.
Without a doubt.
We have the earnings data. We understand the valuation disconnect. Now we need to isolate the specific catalyst that will push Broadcom past the algorithmic noise and toward that $470 plus bull case.
The immediate forward indicator is Broadcom's Q2 guidance, which is projecting $22 billion in consolidated revenue.
That implies a massive 47% year-over-year growth rate.
Yes, but a revenue projection is just a number on a page. The actual physical catalyst, the hardware trigger that makes that $22 billion possible, was showcased at the 2025 OCP Global Summit.
And that is their networking infrastructure. I want to frame this for the listener because this is where the entire AI narrative basically converges.
Go ahead.
Having the fastest custom AI chips in the world without the right networking switches is literally like owning a fleet of Ferraris but only having dirt roads to drive them on.
That's the perfect analogy.
You can have all the compute power imaginable, but if you can't move the data between the servers instantaneously, your Ferraris are just stuck in the mud. You need the highway. And right now, the entire industry is staring at a massive traffic jam.
And Broadcom is the sole contractor building the highway to solve it. At the OCP Summit, they laid out the hardware triggers. They are aggressively deploying the Tomahawk 6, the Tomahawk Ultra, and the Jericho for Ethernet switches.
Right.
But the absolute critical piece of hardware, the technology that will define the next 5 years of AI scaling, is their third generation TH6 Davison co-packaged optics, or CPO.
I was looking into this co-packaged optics tech, and I want to make sure we get the mechanism right. From what I understand, they are physically slamming the optical transceivers right next to the silicon switch on the board.
Yes, directly on the same package.
On the surface, it seems like it's just about saving physical space on the server rack, right?
Space is part of it, sure, but the real enemy here is physics. In a massive AI cluster, you have tens of thousands of chips communicating constantly.
And traditionally, pushing that electrical data through copper wires from the switch to a separate pluggable transceiver introduces massive problems.
Exactly. When you push high-frequency signals through copper over any real distance, the signal degrades rapidly, and it generates an immense amount of heat.
And heat requires cooling, which requires power, which absolutely destroys your operating margins.
Bingo. Co-packaged optics physically integrates the optical transceivers directly onto the exact same substrate package as the switching silicon,
which radically reduces the microscopic distance the electrical signal has to travel before it's converted into light.
You are slashing the electrical trace lengths down to millimeters. That physical change drastically slashes power consumption, eliminates the heat generated by pushing signals through copper, and vastly improves end-to-end link reliability and latency.
And by deploying these specific networking components, Broadcom is laying the physical roadmap for that 10-gigawatt compute deployment by 2027.
Which is exactly why this is the major catalyst.
So here is the contrarian view for this entire thesis. The market consensus right now is heavily, almost exclusively, focused on chip fabrication capacity. Everyone is reading headlines about NVIDIA's supply constraints regarding HBM4 memory delays from SK Hynix.
Yep, the market is obsessed with it.
And just to clarify for the listener, HBM, or high bandwidth memory, is physically stacked directly on top of the GPU, making it a severe, complex manufacturing bottleneck. So investors are staring exclusively at the chips.
And that is the blind spot. What the market is missing is that the next critical bottleneck in AI scaling isn't the chips at all. It is the inter-rack and inter-data center connectivity.
You can manufacture 1 million GPUs, you can stack all the HBM4 memory you want, but you literally cannot connect them into a single cohesive AI brain without next-generation networking switches.
Exactly. And there's a massive architectural war happening right now in data center networking. NVIDIA uses InfiniBand, which is a proprietary networking protocol.
Right. If you buy NVIDIA chips, they strongly push you into their closed InfiniBand ecosystem.
But Broadcom champions Ethernet. They are taking the ubiquitous, open standard networking technology that already runs the entire internet, and through hardware like the Jericho 4 and Tomahawk 6, they are supercharging it to handle AI workloads.
And hyperscalers hate being locked into proprietary ecosystems. They want the open standard of Ethernet.
And Broadcom is providing the absolute highest tier hardware to make that happen. They are solving the networking bottleneck, making themselves indispensable to the data center architecture while simultaneously locking down the custom silicon market.
It is a brilliant dual monopoly strategy, which really allows us to synthesize this entire deep dive for you, the listener. We started by asking if Broadcom was the hidden gem of the AI infrastructure boom.
And the data paints a very clear picture.
Let's connect the dots of everything we've unpacked. First, we saw that Broadcom is leveraging its custom ASIC dominance, its highly efficient, permanently etched custom molds, to drive massive long-term inference revenue.
Securing tens of billions from hyperscalers like Google and Anthropic.
Exactly. Second, we established that this specific type of locked-in $110 billion backlog revenue totally changes the fundamental risk profile of the company.
It justifies a premium, utility-like multiple, exposing the massive flaws in traditional cyclical DCF valuation models that algorithms use to just blindly label it overvalued.
And finally, we identified the definitive forward catalysts. Broadcom isn't just selling chips. They control the critical networking infrastructure, the Ethernet switches and co-packaged optics.
The tech that bypasses the physics of copper wires and is absolutely required for the next phase of AI scaling. They control the custom compute, and they control the connectivity.
I want to leave you with a final provocative thought to ponder as you evaluate your own portfolio allocations. We know that the market is currently addicted to the AI training phase, a phase entirely dominated by general-purpose GPUs.
That's the current consensus, yeah.
But as AI inevitably matures from training into the daily, relentless, power-hungry inference phase, what happens to the entire hardware landscape if hyperscalers like Amazon, Meta, and Google completely bypass those general-purpose GPUs in favor of their own in-house Broadcom-designed architecture?
The balance of power in the tech sector shifts entirely. It moves from the off-the-shelf universal vendor right over to the custom infrastructure partner.
If you remember one thing, it's this. NVIDIA built the engine for the AI boom, but Broadcom is laying the tracks, and in the long run, the infrastructure owner always wins.